So I'm going to turn it first over to Jan and let Jan discuss, historically, what have the trends looked like in this M&A world in TNL? Jan, take it away.
Thanks, Ron. So 47 years ago, I was sitting in a room in the beautiful historic Customs House on Battery Street in San Francisco, taking the Customs Broker license exam. And after that, I went around the corner to Bricks, which was the local hangout for customs brokers, to have a stiff drink, because if you've ever taken that exam, you know that that's exactly what you need after the exam. Then I went back to the office and I sat down in front of a commercial invoice and I rated it, and then sat in front of my IBM Selectric typewriter and typed 3461s, 7501s, and delivery orders. So I go back quite a ways in this industry, and that wasn't even my first job in the logistics industry. In that entire span, I've only seen 3 truly industry disruptive events. The first was containerization, which occurred in the 50s and 60s. It created globalization. It significantly increased access to foreign markets, both for import and for export, increased volumes, changed access to not just foreign markets, but foreign labor. It changed supply chain. It changed the approach to how you're going to fulfill products. That inevitably led to a series of free trade agreements, such as the Generalized System of Preferences, GSP, and the formerly NAFTA, now the USMCA, and a number of other free trade agreements, which have only exacerbated, or I should say, added to that trend. The second was the technology revolution. I mentioned that I sat in front of my IBM Selectric typewriter. I doubt that, I don't even know if any of you even have typewriters in your office anymore, but everybody has a computer on their desk. When I started in this industry, what we did was we moved cargo. Now we move information every bit as much, if not more, than moving cargo. Dramatically changed the way that we do our business, what's expected of us from our clients, and how we value our businesses and how buyers will value the business in terms of your IT pack. Is it scalable? Is it compatible with theirs? Is it sophisticated? And it also affects your expense base in terms of what you have to invest in technology to support your services. The third event was the pandemic. The pandemic dramatically changed everything in our industry. I did not grow up thinking I wanted to be a customs broker or a freight forwarder. I didn't know what a customs broker or a freight forwarder even was. That's probably true for all of you. And that's true for people generally. And then suddenly, with the pandemic, supply chain and logistics was in the news every day. Our industry became sexy. I used to go to cocktail parties and people would ask me what I did for a living. I'd tell them and they would like fall asleep. Now I go to cocktail parties and everybody wants to know, well, what's going on? What do you think is going to happen? Suddenly, we're in demand. And we're in demand not just in that regard. We're in demand from the marketplace. We started making dramatically higher profits. We became much more desirable for acquisitions. People were making a lot of money. Everybody wanted in on the game. Well, if you're a seller, you're making a lot of money. Why are you going to sell? I'm making a lot of money. Why should I sell? So you had to be incentivized. So what happened is the valuations went up, supply and demand. Valuations based upon EBITDA, earnings before interest, taxes, depreciation, and amortization. It's meant to reflect cash flow because in an asset-light business, all you're selling is a revenue stream. And so then you get a multiple of your EBITDA, where you are on the multiple, low end, high end, middle end, middle piece, depends upon how you're performing compared to the competition and how desirable you are, the fit. So because I mentioned those 3 events for one reason. I wanted to say that over the course of all that time, only 3 events disrupting our industry means our industry was very stable. It was predictable. As a result, how you value companies and how you structure deals in the M&A space was predictable. There was a formula, if you will, a cookie cutter template, which was 50% of the value paid at close, 50% paid in deferred payments over 2 to 3 years, based upon post-close performance. The EBITDA was based on the previous 3 years average, because you have a little better year, a little worse year, but it wasn't extremely volatile. It would average out. That was the starting point. Obviously, every deal is different. You negotiate from that, but that's the default starting point. That was that way for most of my career, and then the pandemic hit. As I said, sellers had to be incentivized. So what happened was the multiples that I talked about, the range of multiples went from here to here. At the same time, the risk allocation of the 50% on the front end, the 50% on the back end shifted more towards the buyers. Buyers had to take more risk. They had to pay a higher price. And it wasn't based upon the previous 3-year average EBITDA, because the previous 3 years was aberrant. So it tended to be based upon the TTM, the trailing 12 months. Even that's aberrant now. So what's happened now is we've gone into the post-pandemic. The pendulum has swung back, as you all know. Profits are down, volumes are down, rates are down. There's talk of potential recession. The debt markets are higher. All of that stuff is adding. So that premium, that incentive premium, is going away. It's no longer, sellers don't have to be incentivized to sell that way. They don't have to be paid a premium. Buyers aren't going to pay the premium. There's the flip side of risk is reward. The more reward, the more risk you can afford to take. Because profits are going down, the reward is going down, the risk is going up. And we don't have a crystal ball to be able to see what's going to happen in the next 12, 24 months. We just know it's going down now. So what we're doing is we're now searching for, how do we establish this certainty of revenue stream going forward? What is the new normal? That's what we're struggling to determine. So the valuations are coming back down. The premium is going away. The allocation of money upfront versus back end is shifting back towards the norm, the previous norm. And that's really where the trend is at. I'll go into it in more detail later in this presentation. For now, I want to turn the microphone over to my partner, Chris Ahrens, to talk about the differences between buying and selling in our industry.